In a remarkable turn of events, Turkey's stock market has reached unprecedented heights, marking a significant milestone as investors display an increasing appetite for risk. On Thursday, the Borsa Istanbul Stock Exchange's benchmark BIST 100 index soared for the fifth consecutive day, achieving a new intraday record by surpassing its previous high of 11,252 points set in mid-July 2024, now peaking at over 11,301 points. This impressive rally has translated into a nearly 15% return for investors since the start of the year, showcasing the market's resilience and potential. The index kicked off the trading session at 11,195 points, reflecting a gain of 61.25 points, or 0.55%, compared to the previous day's close. By 3:35 p.m. local time in Istanbul, the index had risen further, showing an increase of 1.15% and trading at 11,263 points. Notably, the banking sector also experienced a boost, with the banking index climbing by 1.58% and the holding index increasing by 0.70%, both starting the day on a positive note. Earlier this month, the BIST 100 index had crossed the significant 11,000-point mark for the first time since July of the previous year, signaling a strong recovery. Analysts have identified key technical resistance levels for the BIST 100 at 11,300 and 11,400 points, while support levels are established at 11,100 and 11,000 points. Since the beginning of 2024, the BIST 100 has outperformed many of the world's major stock indices, boasting a return of approximately 14.4%. The recent surge in the stock market can be attributed to growing optimism surrounding Turkey's disinflation efforts and a more favorable geopolitical climate, particularly with signs of reduced tensions in the Middle East and hopes for a resolution to the ongoing Russia-Ukraine conflict. Additionally, the Central Bank of the Republic of Turkey, CBRT, has resumed its rate-cutting cycle, which has further fueled market confidence as inflation shows signs of slowing down under a stricter policy framework. In a significant move last month, the CBRT reduced its key policy rate by 300 basis points to 43%, reigniting the easing cycle that had been interrupted by political instability earlier in the year. This followed a period in April when the bank had raised the one-week repo rate to 46% from 42.5% and increased its overnight lending rates to 49% due to market volatility triggered by the arrest of Istanbul Mayor Ekrem İmamoğlu on graft charges. Before the rate hikes in April, the CBRT had been gradually lowering rates since December as inflation began to ease. As of July, annual consumer price inflation had decreased to 33.52%, continuing a downward trend after peaking at 75% in May 2024. The bank projects inflation to drop to around 24% by the end of this year, with ambitious targets of 60% by the end of next year and 9% by the end of 2027. In a separate announcement on Thursday, it was revealed that the CBRT's total gross reserves have reached a record high of $176.5 billion as of August 15th, marking an increase of $2.14 billion from the previous week's total of $174.4 billion. CBRT officials have indicated that the Monetary Authority will continue its policy of accumulating reserves. Since the beginning of 2025, all sectors, with the exception of sports and insurance, have reported gains. The leasing and factoring sectors have led the charge with an astonishing surge of 378.05%, followed by tourism at 57.86% and construction at 57.08%. The banking index has also seen a respectable increase of 11.9%, while the holding index has risen by 23.4%. Out of the 100 stocks listed in the BIST 100, 65 have shown gains this year, while 32 have experienced declines. The overall market capitalization of the BIST 100 has now surpassed TL $10.3 trillion, which is approximately $254 billion. But here's where it gets controversial. With such rapid growth, can this momentum be sustained? What do you think about the current state of Turkey's economy and its stock market? Are you optimistic about the future? Or do you see potential pitfalls ahead? Share your thoughts in the comments.